Hello friends, we are here to discuss the Axis Equity Hybrid Fund which has just completed a year. The fund is part of the aggressive hybrid category which invests 65 to 80% in equities and the rest is invested in fixed income securities. The equity component follows a bottom-up stock selection process of best ideas. The bottom-up process of stock selection works on selecting companies with best appreciation potential on a fundamental basis. The fund seeks to invest in quality companies with best management track record and sustainable business models. The debt component invests in sovereign bonds and as well as corporate bonds. The equity component follows a FAME approach for creating a balanced portfolio of consistent alpha generators. It comprises of the core portfolio, which includes high ROE companies that have been consistently delivering good performance. This includes a group of matured companies which are generally large cap in nature that lend stability to the portfolio, as well as high growth mid and small cap companies which help generate alpha to the portfolio. The non-core portfolio consists of frontier ideas which are generally pure cyclical or beta names or some commodity ideas, as well as event-based ideas that try to gain from the mispricing in the market. The matured companies will be comprising of 50 to 70% of the portfolio. The alpha generators would comprise 10 to 30% of the equity portion, while the non-core frontier ideas will maximum be up to 25%, as well as the event-based would be restricted to 10% of the equity portion. In terms of positioning, given the current slowdown across industries, the portfolio is positioned more towards matured companies that can weather the storm well. In addition, we have also focused on a few high growth companies across a few sectors where we are seeing growth being delivered right now. In addition, as we start seeing better economic revival across driven by the government measures, we would try to add a few more cyclical names as well as seek more opportunities in the mid and small cap space. Our debt strategy is active in nature and seeks to generate absolute returns across interest rate cycles by investing in sovereign as well as corporate bonds. Our current mix of the portfolio is 80-20 mix of corporate bonds with 1 to 4 year maturity as well as government bonds in the short term space respectively. The banking liquidity remains in an oversupply mode with around 2 lakh crores of excess liquidity for the last few months. With the RBI emphasizing on pass-through of rate cuts, we expect the money market as well as the short-term government corporate bonds to be well bid. Our current portfolio stance will benefit from this, given that there is about 200 bips of gap between the corporate bonds as well as the operative rates. With the banking liquidity remaining in a surplus environment, we expect the gap between the operative rate and the short-term bonds, which has elevated at about 200 bips level currently, to see a natural compression. This should benefit our current portfolio stance. Thank you and happy investing days for you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.